All right, today I want to address the biggest criticism with my income assets, and that is return of capital. If I click into my income assets, I hold Divo, jepi, and my custom covered call income focused ETF. And all of these utilize return of capital to some extent. And trust me, I've seen the comments. You guys do not like return of capital. Some of you guys think that it's a Ponzi scheme. So that's why in this video, we're going to finally address return of capital and see how it affects my funds. I want to say right off the bat that I'm not an expert in this field, but I've done some research and I have a decent baseline understanding, and that's what I want to pass on in this video. If you want a more in-depth analysis of return of capital, there's a great video that I'll leave linked down below. All right, so this is the basic outline on how we're going to be tackling this. So the first thing we're going to find out is what exactly is return of capital. Then we're going to look at how a fund actually makes money and how it returns capital to investors. We're going to look at both the good and the bad when it comes to return of capital. We're also going to take a look and see how income from selling options plays into return of capital. And then we're going to finish off the video with an update on my income funds that I invest in. All right, so return of capital comes from when funds return a portion of an investor's original investment back to them. So return of capital is exactly what it sounds like. You're just getting a small portion of your initial investment paid back to you in the form of a dividend or a distribution. And that's why on the surface, return of capital sounds like a super negative thing in all situations. And what you need to know is return of capital can be a negative thing, but it can also be used in a positive way within a fund. So to better understand what's going on here, we have to establish how an ETF can grow. How can it generate its returns? And the main ways are as following: interest, dividends, realized capital gains, and unrealized capital gains. These are all the ways that the NAV, or the net asset value, can go up over time. And the thing that I want to focus on when it comes to return of capital is the unrealized capital gains, because interest, regular dividends, and even sometimes realized capital gains can be distributed as investment income and standard dividends. But when it comes to having unrealized capital gains within an ETF that has a specific goal when it comes to a payout amount, like Divo, for example, aims to have roughly a 5% dividend yield, they can tap into the unrealized capital gains to meet that payout goal by having return of capital. That, of course, has a big caveat that there is capital appreciation. So the management of an ETF could be in a situation where the net asset value is increasing, but they do not want to sell any of their positions quite yet, but they have a payment goal that they want to meet. And in that scenario, they can use return of capital to give unrealized capital gains back to the investor. And this article has two pretty solid paragraphs about this. So it says, isn't this the same as giving investors back their own money? Not necessarily. If a fund chronically distributes more cash than it generates in dividends, interest, and realized capital gains, the fund's unit value, or NAV, could well erode over time. This would indicate that investors are effectively getting their original capital returned to them. However, if the fund also has significant unrealized capital gains to make up for the return of capital being distributed to investors, the fund's unit value could remain steady or even rise over time. So return of capital in and of itself isn't necessarily a bad thing. So hopefully that article did a decent job explaining this in a bit more detail. But to keep it simple, the way that I determine whether or not return of capital is being used in a positive or a negative way is the growth of the NAV over time. So generally speaking, as long as the net asset value of a fund is growing and appreciating more than the portion of the distribution that's made up by return of capital, then essentially all that's going on is the fund is distributing unrealized capital gains back to you to achieve a payout goal. Okay, so let's take a look at Divo's distributions as an example. So each line here is one of the monthly payouts from Divo. And over here we can see that the return of capital makes up roughly 82% of that dividend payment. This does fluctuate, so in August of 2021, the return of capital made up about 61% of the overall distribution. So that means out of the roughly 5% dividend yield, 3% of it, just roughly speaking, is return of capital. And funny enough, that's almost exactly how much Divo themselves say come from option premiums versus actual dividends, which leads me to believe that in this case, option premiums are being categorized as return of capital. I do not know that for fact, so please correct me if I'm wrong, but that seems to be the case based off my research, and I'm going to touch more on this topic later on in the video. Now, in order to determine whether or not that's a positive use of return of capital, we have to look at the NAV growth of divo over time. And right here we can see that year to date, the NAV of divo has grown 18%, and over the past 1 year it's up 28%, and over the past 3 years it's up 16%. So when it comes to my analysis of return of capital in divo, the distribution, as we saw, was only about 5%, and roughly 3% of that is return of capital. Meanwhile, the net asset value of divo has grown 28% over the past 1 year. So that indicates to me that divo is using return of capital in a positive way to return some of this unrealized capital gains to me in the form of cash dividend payments. Now, return of capital actually has other benefits, and I want to read this paragraph from a Fidelity article to highlight this. So a fund may have unrealized capital gains in the portfolio, and the portfolio manager doesn't want to sell a holding just to meet a distribution commitment. This is constructive return of capital because the portfolio manager is, theoretically at least, continuing to invest for a fund's total return instead of just for a distribution rate. So on top of using return of capital to distribute unrealized capital gains back to investors, management can use return of capital to have extra flexibility within the portfolio in order to generate better overall total returns. So coming back to my portfolio, that's why I like divo and jepi, even though they use return of capital, because in my take, these funds implement return of capital in a positive, constructive way. It's not eroding the NAV over time, and management is using it to have more flexibility and not have to sell different securities just to meet a payout goal. Now, return of capital actually has another advantage for investors, and that's that they are tax deferred. So with divo, we saw the return of capital rate was roughly 60% of the overall dividend, and that means that portion of the dividend, I do not currently pay taxes on it. Instead, it reduces my cost basis of the position. So eventually, if I go to sell out of divo, that's when I would have to pay taxes on my return of capital. And I have to say, that's a pretty nice advantage. It gives you, the investor, control over when you realize taxes. And in my personal situation, I do not plan on selling my income generative assets anytime soon. So I'm going to be enjoying tax deferred income for quite a while. But of course, divo isn't the only fund that does this by any means. Another very popular fund is BST by BlackRock. This is a science and technology trust with a 5.5% dividend yield. And if we take a look at the dividend history of this fund, we can see how consistent this dividend has been and how they've been increasing it over time quite aggressively. And if we look into the documents of this fund, return of capital is 100% of the distribution. And in this situation, it's okay and healthy because the net asset value of the fund has been appreciating a lot. Now, moving on to this next point, I want to talk about how income from selling options plays into return of capital. So these are the distributions for qyld, very similar to qyld, and this of course has no price appreciation at all, and instead it sells at the money covered calls to generate as much income as possible. And here the return of capital is almost 100%. But if I scroll up a little bit on this document, I want to read this line right here. So it says, the portion of the distribution which is not a dividend shall be applied against and reduce the adjusted cost basis of the stock. So to me, it seems like the option premium collected by selling covered calls is categorized as return of capital because it's not a pure regular dividend. And looking at the NAV growth of qyld over time, year to date it's up 17%, and over the past 1 year it's up 25%. This ETF has a dividend yield of roughly 8-9%, so it's well below the growth of the NAV. And again, because of that, I view qyld as sustainably using return of capital. And in this scenario, the quote-unquote return of capital is just the income generated by selling covered calls. All right, so let me give you guys an update on my portfolio. I have to say, after making my recent changes to focusing more on ETFs and covered calls, I've been enjoying the performance of my fund. So we can see right now the market is open and SPY is up 0.73% and the QQQ is up just under 1%. And if I come to my portfolio, right now it's up 1.01%, so it's doing slightly better than the market. And ever since I made these changes to my portfolio, I've been noticing it's been performing very nicely. We can see the breakdown of where these returns are coming from. Most of it is coming from my growth tech stocks right now. Tech software stocks are doing slightly better today versus large cap traditional growth, although my convictions are definitely doing the best, with the RoC Innovation ETF up 2.2%, Tesla's up 3.5%, and even Apple is up 2.59%. If we take a look at some of my income assets, I have been very surprised with how well Divo has been doing lately. If we filter by just the past one day, it's up almost 0.5% when jepi is up only 0.3%. Of course, I love both of these funds, that's why I put my money in them, but they have different approaches. Divo has blue chip, dividend growth companies, and jepi focuses on undervalued companies, and they both have a different covered call strategy. And then my custom covered call ETF actually performed the best today, and this is a new holding in my portfolio, so I want to see how this does over time, but so far, I am very pleased with how this is going. If I click into it, of course, it's just the S&P 500 with the S&P 500 covered call ETF on top of it. I think eventually I do want to sell qyld and replace it with this, XRMI. It's very similar, it has at the money covered calls, but it also has a 5% out of the money put option. So it just gives you that much downside protection. And I think long term, because of that, it's going to have slightly better performance, although it will have less income. But so far, XRMI isn't listed on M1 Finance, but when it does, I will evaluate whether or not I want to make that change. That's going to do it for me in this video. If you guys are still watching and enjoyed, definitely give the video a like, subscribe to the channel. It really helps me out a lot, and I greatly appreciate it. But regardless, I'll see you guys in the next one.